Preference shareholders are temporary shareholder. Their life may be 4 years, 5 years, 6 years. Revenues are inflows coming in. There are two types of flows. One is called outflow, one is called inflow. Decrease the one's equity of an organization. If the equity value has been decreased, it is called losses. If the equity value has been decreased, it is called losses. Hello, my dear student. I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to hand Fundamentals of Financial Accounting First Semester, Unit 2, Session 1 in favor of BCom. It goes to Elements of Financial Statement. This is only entirely theoretical base. I am going to explain one by one what is equity, what is a share, actually shareholders are, what is a gain, what is a profit, what's the revenue, how you are earning the revenue. All the details is going to be explained very slowly, cleanly. So here the basic idea is Fundamentals of Financial Accounting First Semester, Unit 2, Session 1. So we'll move on now. Elements of Financial Statement. The elements of financial statement are the general grouping of line items contained within the element. These groups will vary depending upon the structure of the business. So we are going to discuss the elements of financial statement. So we'll make a group. What are the contents are there in the elements and what are the things will come under one group. It may vary, but how it will come under the same group, I'm going to explain one by one now. Assets are future economic benefit. Asset is the property owned by the businessman, controlled by the entity as a result of past transaction, other past event. And control of an asset means the capacity of the entity to benefit from the asset in the pursuit of the entity's objectives and to deny or regulate the access of the others to that benefit. These are items of economic benefit that are expected to yield benefit in future period. Examples are accounts receivable, inventory, and fixed. So here, asset means the property owned by the business. So in assets, we are going to discuss when you put the money into the asset, it is going to remain for a longer period. If it is a longer period, it is called the fixed asset. If it is a shorter period, it is called the current asset. And whatever the amount you put on the asset, the benefit of that amount will be have got it a number of years. Here the word is as a result of past transactions and other past events. And control of an asset means the capacity. Control of an asset means the capacity entity to benefit from the asset. What are the benefit we are going to arrive from the asset? And pursue the entity objective and to deny or regulate the access of other benefit. What are the benefit we are going to receive when you put the money on the asset? It may be long term, it may be short term. What are the benefit we are going to arrive? So we can put the money in on accounts of receivable, that's called bill receivable. Inventory means stock, and all fixed assets. Which are the fixed assets are land, building, machinery, furniture, motor car. These are all the fixed assets. When the amount has been put on these assets, whatever the yield we got going to be for a long term. But BR, which can be easily convertible into cash, stock, which can be easily. These two items are called current asset. Fixed asset, I told you, which are the fixed assets are land, building, machinery, motor car, furniture, all the fixed asset. It is going to remain for a long term. We'll move on. Equity. The shareholders' contribution to the business is called equity. Equity is a residual interest in the assets of the entity after deducting all its liability. This is the amount invested in a business by its owner minus any dividend payouts plus any accumulated retained in earnings. I will explain. The concept of being exact in accounting is determining the value of asset and the cost of liability minus the cost of property and its remind value. Investment by owners, it increases the equity when the resources are transferred in exchange for ownership interest describing an owner's contribution to the firm. The investment by owners represent the share of the stock of a company in exchange for a cash. In a joint stock company, first we have got a partnership, first we have got a sole trader to partnership, partnership to joint stock company. In a partnership, each member is called a partner. In a company, each member is called a shareholder. Whatever they contribute is called share. What is share? Share is a part of share capital. The capital of a joint stock company is called share capital. Whatever the contribution made by each member is called a share. So, what is a share? Share is a part of share capital. Share is a part of share capital. Each member is called shareholder. There are two types of share. One is called equity share, one is called the preference share. Equity shareholders are permanent shareholder. They won't get back their money. Their money will be paid back when the company liquidate. Preference shareholders are temporary shareholder. Their life may be 4 years, 5 years, 6 years. Once the 6 years is, their money will be paid back, including the dividend. Here, the point is, what's called the real shareholders are equity shareholder. This amount invested in the business by its owner. Whatever the amount contribution by the member is called equity after deducting minus any dividend payout to preference shareholder plus any accumulated retained earning that should be added. The concept of being exact in accounting is determining the value of asset. We are finding out the value. When you say put the equity, it's a capital, and the cost of liability will be minus and cost of property and its remaining value. Once whatever the liability which you are going to pay, that should be deducted. So the company members are shareholder. Whatever they contribute is called a share. Share is a part of share capital. Each member is called a shareholder. So I already told you there are two types of shareholder. One is called equity shareholder, another is preference shareholder. Equity shareholders are permanent shareholder, whereas preference shareholders are temporary shareholder. We'll move on. Liability. Liabilities are the future sacrifice of economic benefit that the entity is presently obliged to make to other entity as a result of past transaction, other past events. A liability is a present obligation of enterprise arising from the past activity, the settlement of which is going to be an outflow from the enterprises of an asset, incorporating economic benefit. Liability refers to the debt a business as an enterprise owes to its owners and outsiders. So anything payable by the company to the outsider or owners is called liable. The company is liable. So bills payable is a liability, creditor is a liability because who has to pay? The company has to pay. So liable, the company is liable to the owners or outsider. It may be whatever the outsider. So out of the asset, the liability will be deducted. Whatever the difference comes, that is the capital. Total asset minus total liability. Whatever the difference comes, that difference we call as a capital. So asset means the property we are having. Liability means which we have to pay. Liable. The company is liable to outsider, to the owners. It may be bills payable, it may be bank loan, or whatever the outstanding which you have to pay. It may be outstanding salary. Whatever things are there, you have to pay. Owners and the outsiders are called. It's a liable. Liability are the future sacrifice. It's a future sacrifice. So we are going to pay that particular money after 1 month or 2 months. The company is liable to owners, company is liable to outsiders. Revenue or income. Definition of revenues. Revenues are inflows coming in. There are two types of flows. One is called outflow, one is called inflow. Inflow means coming in, outflow means going out. I will repeat. What do you mean that? Inflow is coming the cash, outflow means going out. Revenues or inflows, other enhancement or savings in the outflow or future economic benefit in the form of increase in asset or reduction in liabilities of the entity. So revenues are the income which increase the value of the asset, or if they pay the money, it reduce the liability of the entity other than those relating to contributions by owners that result an increase in equity during the reporting period. Revenue is the income generated from normal business operation and includes discounts and deduction for returned merchandise. Revenue is the income generated by the normal business activities of an organization constituting the growth. So, whatever the income we earn, out of the income, we pay the liabilities, or whatever the expenses are there, that expenses will be paid out. Whatever the difference come, that is the net income of the business. We earn the total income minus liability minus expenditure will be paid out. Whatever the amount left over, that is called the net income. Then, definition of expenses. Expenses are consumption or losses of future economic benefit in the form of reduction in asset or increase in the liabilities of the entity. So expenditure is mean. So here benefit will be deducted or increase the liability. Either the benefit will be deducted or increase the liability of the entity other than those relating to distribution to owner that result in a decrease in equity during the reporting period. So when there's a expenditure comes, no, naturally, so equity will be decreased. An expense is the cost of operation that a company incurs to the generate revenue. Costs represent gross outgoing expenditure of the company for manufacturing products or providing services to the customer. Accounts record expenses through one of two accounting methods: cash basis or accrual base. Cash basis means actually cash paid, actually cash received. Accrual basis means to be received, to be paid. What is cash basis? We pay the expenditure and receive the income. Or accrual basis, to be paid and to be received. So when we have got a income, we have got a expenditure. When the income comes, the asset value will increase. When the expenditure comes, naturally we pay the asset value. Asset value will be reduced. The liability will be reduced. Here, okay. Then we'll move on. Definition of expenses. It can also be defined as decrease in net financial position of the entity other than decreases arising from ownership to contribution. So whatever the expenditure comes, the ownership contribution will be there. Expenses are recognized when a decrease in the future economic benefit related to decrease in an asset or increase of a liability has arisen that can be measured reliability. In effect, the recognition of expenses occurs simultaneously with the recognition of increase in liability or decrease in asset. For example, the depreciation of asset decreases asset and the expense is recognized. Expenses include both the expenses and losses. So when there is a depreciation in the value of the asset value will be decreased. So we are going to discuss the expenses of the concern. When the expenses come, naturally the income will be reduced. If there is a depreciation, the asset value naturally decrease to that particular. For example, if the cost of the asset, assume that land or building is about 1 lakh, 10% has come down depreciation, 10,000. Today's value become 90,000. 10,000 may be considered as a loss. It will be debited to profit and loss account. Gain. Profit occurs as a result of the owner's equity addition in frequent and irregular incident transaction, say a sale of machinery worth an amount beyond its accumulated division book cost leads to a gain for a business dealing in trade other than that of building and selling machinery. By chance, if any asset is sold, the book value of asset may be 10,000, sold for 12,000 at a profit of 2,000. That's a gain of the business. Here, say a sale of machinery. Machinery has been sold. The real book cost means whatever the cost available in the balance sheet is called the book value. The cost may be 10,000. It is sold for 12,000 at a profit of 2,000. That's called the gain. Then loss. The loss refers to a decrease in the owner's equity of an organization. If the equity value has been decreased, it is called losses from non-perpetual transactions that are to their actions. Other than the sale and purchase of equipment, a sale of equipment at a decreased fee, then its book price, much less depreciation losses could result is an income. So by chance, what we are going to explain, when there is an asset in the balance sheet about the book value, about the machinery itself, 10,000, it has been sold for 8,000 at a loss of 2,000. That is called the capital loss. That loss shows the organization is decreased the ownership. The equity of the ownership will be decreased because of the loss. Then disclosure of elements. The purpose of accounting is to provide information that is useful to decision maker. So whatever the decision taken, you have to take into consideration some of the information. The full disclosure principle means that the financial reports should include any information that could affect the decision made by external user. This is important. Of course, the benefit of that information, as noted earlier, should exceed the cost of providing the information. So it should give the proper information so that we can have the disclose everything. The conceptual framework indicate that full set of financial statement is necessary to meet the objectives of financial reporting. If you want to financial reporting, you must have a full objectives of the concern. Financial position at the end of the period. Financial position means what is the value of the asset, what is the value of the liability, how much capital is available. So what is financial position? How much asset we are having, how much liability we have to pay. The balance is called, we say, capital. Profit or loss means at the end of the year when you prepare the profit and loss account, is it a net profit or a net loss? Cash flows during the period, how much cash has coming, inflows we say, how much cash is investment is called outflow, whatever the return is called inflow, how much we receive inflow is be taken into consideration. Investment by and distribution, investment by and distribution to owners during the period, comprehensive income, total non-owners changes in equity for the period. Here, whatever the investment is made, it is called the cash outflow. How much is coming in? It's called cash inflows. Are we are taking into consideration the profit of the company. We say that net profit, or when you prepare the financial statement, final account, first we prepare a trading account, then you prepare the profit and loss account, then you prepare the balance sheet. Trading account gives the result of gross profit or gross loss, whereas profit and loss account is prepared to find out the net profit or net loss, whereas a balance sheet is not an account. It is a statement of assets and liability. It shows the financial position, how much asset we are having, how much liability we have to pay. So this is a clear picture of the entire company where how much cash inflow, how much cash outflow, how much a net profit, what is the financial position. Come backside. Here important. Equity. In a joint stock company, each member is called a shareholder. Whatever they contribute is called a share. So, a company, each member is called shareholder. Whatever a contribute is called share. Share is a part of share capital. There are two types of share. One is called equity share, and called a preference share. Equity shareholders are permanent shareholder, whereas preference shareholders are temporary shareholders. Liability. Anything payable by the company to outsider is called liability. So the company has to pay back to owners or a company has to pay back to others. So asset minus liability is called to capital. Then whatever the income you earn is called revenue. Whatever the expenditure is made for expenses. Then here profit earned, gain. When the asset has been sold more than the face value, it's called gain. Which is sold less than the face value, it's called losses. Then whatever the information is there, we have to financial position, disclosure of all element, so that the company take the action. Financial position, how much asset we are having, how much liability you have to pay, what's the capital, profit or loss, whether the company earn the profit or suffer the loss by preparing the profit and loss account. Cash inflow, how much inflows are there, how much outflows are there. Investment, how much have been invested, that's called cash outflow. Comprehensive income, how much income earned. All the details should be given to company so that they can disclose all the elements of the company. Hope you understand. So this is only theory portion. I explain about the equity, about the liability, about the asset, about the gain, about the loss, elements of financial position. So one question will be asked here, only theory question. Hope you understand. We'll meet in the next session with a problem of third unit. Till then, goodbye. Meet in the next class.